If you're thinking about buying your first home and you've even maybe started dabbling and looking at some houses, there's a really good chance you've probably seen the term FHA and the term conventional. What is FHA? What is conventional? What do those things even mean? We're going to break it down. Let's go. So, just to get everyone up to speed, no matter where you are in your home search process, FHA and conventional are two types of financing programs that you can use to get a home. In this video, I'm going to explain what FHA is, what conventional is, what the difference between those things are, and how it may apply to you. So let's dig right in. FHA, what is it? FHA stands for Federal Housing Administration. So what is an FHA loan? The FHA loan is a loan that is backed by the Federal Housing Administration. Now, because this loan is federally backed, the FHA assumes some of the risk on that loan, and in the event that a borrower defaults, the FHA will pay back the lender a portion of its losses because of that borrower. And because of that, this means that lenders can have like looser qualifications on those FHA loans because there is less risk involved with those loans. So maybe to better understand these FHA loans and the Federal Housing Administration, let's go back to when and why the FHA was created in the first place. So back in 1934, during the Great Depression, the Federal Housing Administration was created in part with the National Housing Act. Now, at the time during the Great Depression, if you didn't know, the housing market, among many other things, was not in the best of shape. And during that time, most home loans required 50% down, and they had way shorter repayment terms, like 5 to 10 years, which in turn obviously kept the idea of home ownership out of reach for a lot of people. So during the Great Depression, when everything was struggling, the FHA was created to help stimulate the housing market and to make home loans way more accessible to the vast majority of people. The FHA introduced longer loan terms that we're used to seeing these days, the 15 to 30-year mortgages, and they offered much smaller down payments, which in turn made mortgages and the idea of buying a home way more affordable for most families. And like I mentioned, it also provided mortgage insurance, federally backed mortgage insurance, which then protected lenders against defaults, which made them feel more safe and also encouraged banks to start lending again. Because of all this, it really did help revive the housing market at the time. Now, what is a conventional loan? Conventional loans are the original form of mortgages. They are private loans funded by private lenders without that government backing that the FHA loans have. Like I said, before FHA, they required much larger down payments, somewhere between 30 and 50%, and those loan terms were far shorter, like 5 to 10 years, and sometimes with a balloon payment at the end of those terms. But after the FHA's introduction, conventional loans kind of had to step up their game, and they adapted, which they had to genuinely stay competitive. And because of that, they gradually started offering longer loan terms and requiring lower down payments, but still without this government insurance back behind them. Now, today, government loans are typically backed by either Fannie Mae or Freddie Mac, and they're described as either conforming or non-conforming. Conforming loans meet the standards set by Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are two government-sponsored entities that buy mortgages from lenders and then sell them on the secondary market. And now, because they meet these requirements, these types of loans are typically easier to qualify for with lower rates and smaller down payments, as opposed to these non-conforming loans. Now, the benefit of these conforming loans is that in comparison to FHA, they can offer a lot more flexibility, particularly for buyers with strong credit, larger down payments, and a stable income. Now, the difference between these conforming loans and the non-conforming loans is that the non-conforming loans do not conform to the standards set forth by Fannie Mae and Freddie Mac. This is usually due to the size of the loan itself, the borrower's profile, or less typical unusual property types, things like mixed-use buildings or investment properties. These are usually harder to qualify for due to the fact that they usually have higher rates due to the risk involved with them, and they can typically require bigger down payments, which can kind of factor out a lot of borrowers. For the record, this is not lending advice. I am not a lender. I'm simply just relaying the facts to you so that it can kind of help you better understand what the difference between these two things are. Obviously, speak with the lender, your lender, to help help clarify and get specific answers on any questions you may have. Because again, I am not a lender. I'm a real estate agent. I work for the Twin Cities team here in Minneapolis, and I'm really here to just help clarify, first-time home buyers really wrap their head around the process that is buying a home. There's so much to it. There's so much involved. There's nuance and so many questions to be asked. So my goal is to just kind of help clarify anything and, help, like I said, help wrap your head around just the idea of a lot of these things. If you want to speak directly to me, if you want to sit down and have me answer questions, if you're looking for a home, hit me up. You can email me at paul@thetwincities.com. Find me on Instagram at paul2thetwincities. Anything like that. I'm so happy to help. Happy to just hop on a call and answer questions. It benefits me as much as it benefits you, because with real estate, you're always learning. There's always new things to be had. No transaction is ever the same. So as helpful as it would be for you to get answers, it's always great as an agent to get asked these things to, keep fresh and also differentiate the nuances between these questions, as like no transaction is the same. No situation looks the same for any buyer. Okay, back to FHA and conventional. Let's break down the different loan limits for each of these loans. Paul, what the heck is a loan limit? The loan limit is the maximum amount of money that home buyers can borrow for these loans. They vary by region, property type, and like your local real estate prices. So for Minnesota specifically, in the year 2025, for FHA, the loan limit is around $529,000 in the Twin Cities metro. Outside of the metro, the loan limit is set at about $524,000. A lot of that is just because as you get further outside of the city, real estate gets cheaper, properties are cheaper. Therefore, the FHA chooses to and is allowed to lower that loan limit. Now, for conventional conforming loans, they can go up to about $806,000, which in turn obviously allows for more expensive property purchases. Loan limits are pretty cut and dry. I'm not really sure, the questions that could arise from that. Obviously, you don't have to use the entire loan limit. I mean, I think that goes without saying, but it is nice to know and just have an idea of what those loan limits look like for you as a buyer. Now, another difference between these loans and how they differentiate who can apply and who can qualify for these different loans is based on credit score. Now, for FHA loans, again, more accessible. The idea is to help people get into home ownership. So in order to qualify for an FHA loan, you need a minimum credit score of 580. And with that 580 credit score, they require 3.5% down on the property. Now, if you're between 500 and 579, you can still qualify for FHA financing. However, at that lower credit score, they're looking for more like 10% down payment on the property. It's a little bit different for conventional loans. Conventional loans typically require a score of 620 and above to qualify for the loans. We most commonly see 5, 10, and 20% down with these conventional loans. However, the conventional 97 loan, which applies to first-time home buyers, allows for 3% down and you can finance the other 97% of that purchase price. Now, that's a pretty sweet deal and can definitely be something to debate if you do qualify for a conventional loan, but you see the benefits in FHA. If you can work out the prices, and that 3% down, 97% finance conventional can actually make more sense than going with the FHA. One big difference about whether you use FHA and conventional, and I will dig into this later in the video, but the property restrictions are a lot more relaxed with conventional loans. FHA loans can require the property to meet more strict minimum standards, and when that house gets appraised, it's appraised by an FHA specific appraiser. We won't get too hung up on that now. I will dig into that later, but just something that came to my mind as I'm talking about this. Now we're going to jump back. We're going to talk about mortgage insurance. If you don't know what mortgage insurance is, I don't know how to explain it other than it is insurance on your mortgage. Now, FHA requires both an upfront mortgage insurance premium as well as a monthly mortgage insurance premium. Upfront, you can expect to see about 1.75% due at closing for that initial insurance, and that can also often be rolled into the loan. And then there's a monthly mortgage insurance premium, which is typically about 0.55% to 1.05% annually, and that rate depends on your down payment and your terms. A typical 30-year mortgage will range more from 0.8% to that 1.05%, whereas with a 15-year mortgage, that can typically be the lower rate, something between 0.45% and 0.95%. Now, this FHA mortgage insurance premium, if you put less than 10% down, it is with you for the life of the loan. You cannot cancel it. The only way to remove it would be to refinance into a conventional loan once you meet those qualifications of conventional loans. But if you put more than 10% down, that FHA mortgage insurance lasts for about 11 years, and then after that it automatically falls off. For conventional loans, that PMI, it drops off after you reach an 80% loan to value ratio, and FHA is much more strict on this. Most buyers eventually just refinance, like I said, out of the FHA into a conventional loan once their credit and equity in the home really improve. For these conventional loans, you can cancel your PMI anytime after your equity reaches about 20%. The cost of these initial PMIs for conventional loans can range between roughly 0.14% and 2.24%, depending on your credit and loan to value ratio. Notice that is a much bigger window than the difference with FHA. Kind of goes back to what I said earlier, where these FHA loans are way less risky for lenders, and it's why FHA requires this insurance premium in the event that the buyer does in fact default on their loan. Okay. Full disclosure, I just had to run and go do a showing, so I ran out of time, but I made enough progress to the point where I'm not going to start over, so we're just going to pick right back up from where we left off. So I just got done talking about mortgage insurance for both FHA and conventional loans. So the next thing I kind of want to dig into, which I did touch on a little bit, but that would be interest rates, and more specifically like the long-term costs associated with each of those loans. So like I mentioned, FHA typically offers a bit lower interest rates versus conventional loans for those borrowers that don't have as great of credit, because again, the government backing makes lenders feel more safe and confident about lending that money, so they can offer these lower interest rates. And because these FHA loans are like less sensitive to a borrower's credit score and their debt to income ratios, so those buyers with weaker credit scores can often get like way more competitive rates than they would if they were to try and go conventional financing. Now, conventional loans, kind of like I mentioned already, but I just want to really hammer this home. Conventional loans are typically a higher rate than FHA for borrowers with average or a little below average credit scores. However, those borrowers with the strong credit, kind of like 740-ish and above, and a sizable down payment, maybe up to that 20% down, rates can actually then be lower than FHA. Obviously, though, not everybody's in that position where they can put down 20%, even 10%, like when you're thinking about a $450,000 home, having $45,000 just sitting in a bank account, especially if you are a first-time home buyer and you haven't been able to sell a home and then get equity out of that and then put that towards your home purchase, it can just be really difficult with those numbers, which is why FHA can be such a great option for people, especially people looking to get into home ownership. As far as like the long-term costs, I just think something that's like worth noting and just something to think about when you're comparing the two long-term, that sometimes FHA can appear cheaper up front, which can be true, but that lifetime MIP mortgage insurance premium can actually make it more expensive over time, especially if you choose to stay in that loan for a long time. Those conventional loans usually become cheaper long-term because that PMI does drop off once you reach 20% equity. So again, it's different for everybody. It depends on your situation. Obviously, this is something to speak to a lender about, but I think it's good to know all the specifics, especially because it's easy to get that sticker shock. If you see a comparison between FHA and conventional, FHA looks cheaper, it's pretty easy to be like, well, yeah, I want that one. But it is very important to think about long-term, again, especially if you're planning to like stay in this home. So earlier in the video, I did mention that with both FHA and conventional loans, there are restrictions and standards that properties have to meet in order to qualify for a loan. When comparing the two, FHA and conventional, FHA loans require the property to meet much more strict guidelines, and even for appraisal, they're conducted by specific FHA certified appraisers. A few things that they take into consideration for these homes would basically be safe, sound, and secure. That's kind of an easy way way to think about it. Safety, obviously, the home must protect the health and safety of its occupants, must be free of pest infestation, damaged or deteriorating asbestos, mold, chipping or peeling lead-based paint, and the plumbing, heating, electrical systems all must be in good working order. There should be no exposed wiring, no structural dangers to the property, and working smoke detectors and proper handrails for each staircase. The security basically meaning the home must provide adequate protection, so things like functioning locks and doors and windows. The roof must keep water out, can't be any major leaks, and like I kind of mentioned earlier, no major foundation or structural issues or instabilities. And that kind of falls in line with the soundness of the home, which basically is saying that the home must be structurally stable. They're going to look for large cracks in the foundation, shifting foundation, or any significant termite damage. Walls, ceilings, and floors all need to be intact. And if they do find any foundation issues or leaks or significant damage, that must be corrected in order for them to allow the lender to loan this money out. I've seen this firsthand kind of jam people up that are going FHA financing. You know, I've seen people that are like, hey, we see this stuff in this house, but you know, that's okay with us. Like, we'll fix it. We're like handy. We want to do that, which is great. But the biggest issue, the thing that people run into, is that it needs to be fixed before the house can close. So then that's when you enter the situation with the seller. You try and negotiate some of these fixes, and you know, it can just be like a headache, and sometimes they won't get done. And you know, the worst case scenario, the deal kind of falls through. That's why I think it's so important to, you don't have to know every little thing about what these FHA appraisers are going to call out, but even just to like hear them once and kind of just have a general idea of what the conditions should be, so that you know whether or not you're like wasting your time on a home that may look good but is lacking a lot of things that it needs. And just to get like a little more specific, because I think this is super important in regards to the condition of the home, the roof must have at least 2 more years remaining on the life of it and no active leaks, like I mentioned earlier. There needs to be a proper heating supply in working condition. The house cannot rely on something like space heaters as the main heat source. There needs to be a continuous supply of safe drinking water to the home, and all utilities must be operational. Electrical and plumbing must be in safe and good working order. This one might be a little more obvious, but no standing water in the basement, and crawl space and proper ventilation are required in these areas. If there's a well or septic system on the property, it must meet the local health standards, and there needs to be year-round street access to the home. I think the most common things that show up that FHA calls out is peeling paint in homes built before 1978, broken or missing handrails always get called out. Always, always, always. Windows that don't open or close properly, that's another huge one. People are always painting windows shut. Uneven floors and like broken steps, another really huge common one that always shows up. Evidence of mold or excessive dampness always gets called out, and missing carbon monoxide detectors or smoke detectors. I'm sure you can tell based on this list, but it's not like the FHA, they're not looking for luxury. What it boils down to is making sure that the home is safe, livable, and like free from safety concerns. Now, conventional loans are much more lenient than FHA as far as their standards. Because of that, again, that's why a lot of investors or fixer-uppers, they go conventional, because the house doesn't need to meet the exact standards that FHA homes do. As opposed to FHA, for conventional, the roof, appraisers are really only calling out an issue on the roof if it's leaking, actively leaking, or if the condition of it is outright impacting the value of the property. As far as heating and utilities, way less strict. As long as the systems are operational, it usually passes. For water, septic, and well, those standards may vary by lender, but as far as appraisers, they typically don't require a very detailed inspection, as long as there's like no clear issue kind of jumping out at them. Peeling paint, which is like so huge for FHA, for conventional, it's usually typically not an issue unless it does affect the home's condition or value in a major way. As far as structural integrity of the home, the appraisers, they may note problems that they see, any small issues, but minor cosmetic repairs usually pass without any issue. It would only be like major structural problems within the home that could cause an issue. And then as far as like pests and infestations, it's usually only flagged if damage is being caused or if it's required by state law. So as you can see, they are much more lenient. It doesn't mean that, they're gonna still just go into a basically condemned house with nothing working and say, okay, we're cool. There's like a level of livability still, certainly not as strict as FHA. And again, I think that's just because FHA borrowers maybe not financially as strong as people going conventional. So as much as they're looking out for themselves, I like to think that they're also looking out for maybe new homeowners, people that don't know any better potentially. Okay, so let's run back the 5 biggest differences between FHA and conventional. 1, FHA credit score between 500 and 579 for 10% down, or 580 or above to qualify for that 3.5% down. For conventional, 620 is required. Better rates if you're at that 680-ish and above. Down payment, like I said, 3.5% for FHA if you're above that 580 credit score, 10% down if your credit score is ranging from 500 to 579. Conventional loans, you can go as low as 3% down if you're a first-time home buyer. Typically though, we're seeing 5, 10, 20% down for conventional loans. Mortgage insurance, FHA, you will have an upfront and then a monthly mortgage insurance premium. Remember, it's possible to end that after about 11 years if you did in fact put 10% or more down on the home. Conventional, that private mortgage insurance is only required if you're putting less than 20% down. And again, you can cancel after your loan to value ratio reaches 20%. The loan limit in the Twin Cities for FHA, $529,000. Conventional, up to $806,000. And like we just went over, appraisals much more strict for FHA. Conventional, way more lenient, more suited towards those like fixer-upper investment properties. So if you have a lower credit score and you're sitting on limited savings, FHA might not only be the better route, but honestly, it could be a really smart move. As a first-time home buyer, you can also qualify for the Minnesota Housing Startup Program, which if you ever heard someone say that you can get into a home for literally $1,000, that's not a joke. You can literally get into a home for $1,000. I mean, that's such an incredible opportunity for people. And it's like, why wouldn't you take advantage of that? I mean, literally getting a home for $1,000. Just saying. But if you have a credit score of 620 and above, you have a bit more of a down payment save, then conventional can definitely offer a lower price to you and lower cost over the life of the loan. That's all I got for you. We'll see you on the next one.